Welcome to the Mountain Path, the world of finance. This is Ravichandran. This session we will discuss a three-period binomial American pricing model for calculating call and put option, where volatility is given percentage and the yield of the underlying asset is given as a percentage. So, what are all the pre-requirements to learn this model? The basics of the options payoff, option moneyness, the present value discounting techniques, the expected value using probability, and basics understanding of the assumptions and the limitations of the binomial option pricing model. As usual, what are the steps to calculate the option pricing model? First, we calculate the up factor and the down factor, and since here the volatility is given, so we will use a different formula. Second is to calculate the up probability and down probability. Again, we have to change the formula since the yield is given. Call and put options payoff calculations at the end. Then we have to calculate the discounting factor to calculate the present value of the expected values. Then the calculation of the expected discount values, and working backwards, since we are calculating American put options, we have to look into the optimal and whether we can exercise the option yearly. That is nothing but to examine the optimality in calculation of the option values. Now, since the yield is given as a percentage, there will be a slight change in the calculation of the up probability. There is nothing but probability into exponential R minus Q, or R minus yield into and the discrete time minus D divided by U minus D. And since the volatility is given, so the U and D calculation also the formula is different. So exponential sigma into square root of delta T, and the D is 1 by U. So this change the formulas needs to be considered. Let's quickly recap. So this is the three-period binomial tree that we need to construct. The up probability and the down probability needs to be calculated. Let's quickly go into the assumptions of the model. The current stock price is 100, the strike price is 100, and the risk-free rate in continuous compounding basis 5%, and option expiry time is 1.5 years, that is 18 months, and steps for binomial 3 periods. So volatility is given as 20%, and the yield is given as 2% per annum. So first calculate the discrete period, that is nothing but 1.5 divided by 3, that is 6 months, 0.5. And that is the thing. The second one is to calculate the U and D using the formula. So the calculation of U and D is nothing but exponential and sigma into square root of the delta time, that is 0.5. Then D is nothing but 1 by U. The second is to calculate the up probability, exponential R minus the yield, that is here the rate is 5% is the RFR, risk-free rate, minus the yield is 2%. Exponential R minus Q into delta time, that is the discrete time, minus D divided by U minus D. So we have calculated the up probability, and the down probability is nothing but 1 minus up probability, and the discounting factor there is no change, exponential minus and R into T. So we have calculated the minimum required parameters for the binomial option pricing model. Then as usual, the binomial option pricing model, the asset price and the movement in discrete time intervals, it goes with 0 to 6 months, 6 months to 1 year, 1 year to 1.5 years. Now again we have to move backwards. This is nothing but the process is nothing but backward induction. It is stepping backward through time calculating the option value at each node and of the lattice in a sequential manner. Now, so let's put the tree here. 100 rupees is the initial value. It goes by S into U or S into D. Then similarly for the 6 months to 1 year, and you have to multiply the SU into U. And similarly for the 1.5 years, the third time. So you have to calculate. First fix the values of the underlying asset prices at different nodes actually. Then we since this is a call option, calculate the call option payoff value, maximum of the SUUU minus the strike price. So calculate the respective payoff values and since you have fixed the K here, you can simply copy the entire values quickly so that we don't need to waste time. If the adjacent cells are correct, then we can quickly calculate what is the payoff value. Then once you have fixed the payoff value at the end nodes, then we have to calculate the present value of the expected value. It's nothing but the discounting the expected value. Here 52.847 in the up probability multiplied by 15.19 in the down probability multiplied by the discounting factor will give the present value, the expected values. So we are able to calculate, and this green cell represents nothing but the present value, the expected value. Now since there is an American option, so we have to look into optimality. So how do you calculate? So the blue is nothing but the intrinsic value of the yearly exercise. So how do you calculate? Since there is a call option, max of the node value minus the strike price, 0. Here you can see it's 32.68. Similarly here it is 0 here, and here it is a 0 here. Now what we need to do is we need to compare the value, call value, with the expected present value of the expected value. The first one, it is not optimal because, and the 32.68 is less than 33. Here is also is not optimal, 0 is less than 7.64. Here it is not optimal. So in these nodes, now we don't find any optimal to, and we cannot exercise the option yearly. Again we have to move and backwards, and then we have to calculate the present value, the expected value as usual, and we try to calculate the payoff value at this node also. We need to compare whether this value is more than this. So it so happen both these nodes we cannot exercise the option because these two values are not more than the expected values. Again, as the last step, we need to calculate the present value. The expected value is nothing but 20.72 into the up probability, 3.87 into down probability multiplied by the discounting factor. Now the call option price is 12.281. Now let's try to calculate a similarly for the put option, 3-period American put option, and with the 3-period American put option. So using with the yield, so we will calculate it. So with the yield and the volatility. So with the yield and volatility, how do you calculate? The same approach, we fix the tree here, there is no change in the tree values, node values. Again, when you are calculating the payoff value, for a put option, maximum strike price minus the node value, so you calculate the payoff value of these 4 nodes, and then we can see that then we have to move backwards. Then we calculate the present value of the expected value by the green cell. So we calculate that. Then since for American option, we have to look into whether we can exercise early by calculating maximum of strike price minus the node value. So you can, if you examine here, the last one, we are able to get maximum of strike price 100 minus 75.36, and that means the 24.63 is more than the 6.62. So we can exercise the option yearly here. So what you can do is we can simply ignore and the 6.62 value. So we can simply and strike that actually. So we will consider only the and 24.63 while taking into the next iteration. So while moving backwards, so we calculate the present value of the discounted value again, and the greens is a usual thing. Then we calculate whether we can exercise the option yearly for a put option. Maximum of 100 minus 115, 0. Again we can say 100 minus 86, we are getting 13.18 here. But we need to compare. So since it is not optimal because 13.18 is less than 14.71, we can't calculate, we can't use that. So we can again calculate the present value of the expected values, and that gives you a put option price of 8.39. This is thing that we need to follow when yield is given as well as when the volatility is given. So volatility is given, the calculations of U and D changes. Then yield is given, we need to subtract the yield from the risk-free rate when you are calculating the up probability. And a similar thing, let's say instead of a yield is not given, if dividend is given, payable in 2 months. The same model, and volatility is given. When the dividend is given in terms of a dollar, like $5 payable in next 2 months, then how do you calculate a 3-period binomial option pricing model? So everything remains same, and including the, so since the, so the yield is given, dividend is given as percentage, the one of the important steps we need to calculate the adjusted stock price. So how do you calculate adjusted stock price? You have to calculate the present value of the dividend. Since the dividend is payable in 2 months, so 5 into exponential minus RT, that is T here is 2 by 12. So once you calculate the present value of the dividends, subtract the present value of dividend from the current asset price or a stock price, so you will have the adjusted stock price. Now you have to build the tree, and using the adjusted stock price and with the starting point instead of 100 we use the adjusted stock price, then modify the other values accordingly. Then it will be a same process. Calculate the node value, calculate the expected present value, the expected value, again check for optimality at every nodes. If you are able to exercise, otherwise you calculate the call option price, like that how we did. Again for a put, we can see that if we calculate that, we are able to see that there is we can exercise the option at 2 different periods. One is at the end of the 1 year, since the option value is this option exercise value is more than the expected present value, the expected value. Here we can exercise the option. While calculating here, we can see we have to ignore this one. So when we ignore, we simply then we have to calculate only the optional value, put option value here. And now when you are calculating here, you can see that, and 7.610 into our probability, 28.37 into the down probability into the discounting factor. Again we have to see whether you can exercise the option here. Maximum of 100 minus 82.5, 17.49. Here we cannot exercise because it is out of the money, and that is 100 minus 109 is 0 here. And now again, and what you can do is actually we can simply ignore this one, and then while going backwards, so we have to take 3.311 into our probability, and then we have to take this one. We should not take the present value of the, you have to take this one as the, so 17.49 into the down probability into the discounting factor. Now the put option price is 9.399. So what is the logic here? The logic is very simple, and whenever each node we have to check for yearly exercise, and so when we check the optionality, whether we can optimality, and whether the value that we calculate, is it more than the present value, the expected value. So we have discussed the 3-period and binomial option, American option, and using a dividend, using yield, without yield and without dividend, only with the factor in the last 2 videos. Thank you for watching. So we will see the next discussion. We will start discussing Black-Scholes option pricing model and using different methodologies. Thank you very much.